I'd like to thank also again Terrapins for this opportunity in being here and for this summit. The last year we've been here and was a very nice, and I'm looking that happen again. I would like first to maybe how we're going to do. I'm going to make an introduction about the high net worth individual and the hedge fund industry, and that pass the microphone for my colleagues here. So basically, for the high net worth individual, we had two period very clear, which happened first before 2008 and after 2008. And basically, before 2008, there was an abuse, and on the high net worth individual, basically there was an abuse from the part of the managers or funds, which happened in 2008, and also because probably there was too many investment flow to this area, on the hedge fund area, and a lot of people suffer on 2008 from those abuse. And basically what's happening now, people are coming back, so I think that the hedge fund and alternative investment is definitely past the crisis also of 2008, and also for the high net worth individual, looking back, it's an asset, it's a class, the alternative and hedge fund, which basically perform quite well on the relative basis, and also I think people are looking still to invest on that, coming back from what happened in 2008. I think mostly of the industry on this area, on the high net worth, came back again to investment and how it was probably previous of 2008. Basically, talking about Brazil, so this didn't happen with the high net worth individuals starting to look now for Brazilian hedge fund industry. They are looking since already a few years, but basically with 2008 delayed, make a delay on that view on the high net worth abroad. But what is good, what happened in the industry in Brazil happened that didn't have side pocket gates. Basically 98% of the industry respect all the mandates what was about to do, and we think that it will be more and more interest on the high net worth individual becoming more and more investors on the side of the hedge fund in this industry in Brazil. So I would like to pass also to this, and then we make a continue on that, passing the word from my colleagues.
My name is Cesar Stange. I work with a family office, multi-family office, based in Buenos Aires, Gaia Capital. We've been investors in hedge funds for many years. Our firm is already 6 years old. We like hedge funds, but we understand very much what you say, and this is exactly the kind of problem we face when we deal with our families. The two factors, the Madoff first, and then the problems in 2008, also with the whole of the industry and the collapse of the markets. Today have us in a need to re-explain again and again what hedge funds are meant to do for them. And it's always been a difficult on itself to explain hedge funds, because hedge funds is so many things. So, you know, it's not like investing. People would know very easily about equities and bonds, but hedge funds is more difficult space. And particularly in my case, I like to think of them about talent, because strategy-wise is always very difficult. I even have, myself, sometimes difficult with some of the strategies to understand them. So it's always a challenge to try to explain how they fit into our clients' portfolios. Having said that, I also think that hedge funds have failed to do what they said they were going to do in 2008. We've all heard about uncorrelated returns, alpha generation, etc., and this is not what happened in 2008. We saw a lot of beta, we saw a lot of correlation, we saw, it was coming to us. In 2007, we could see the markets, everything was correlating. And I think the way we came out of this, or we are coming out of this crisis, is also a little bit misleading, in my opinion, and therefore, maybe the lessons is not completely learned. Today, the investors, as I happen to talk to them, still don't know a lot about hedge funds. They trust us. That's the truth. I saw the presentation before. I understand about the need to explain more to the clients, but I don't know if you ever tried to put a pitch to a client for more than 15 minutes on something. Imagine trying to do it on 30 hedge funds, no? So it's unrealistic, in my opinion, that more information will help them. I think information will help professionals. And I think professionals deserve to know much more than they know today about hedge funds and all around. So this is a little bit before you make a little bit of questions to us. I want to pass on to Ricardo, which has a long track record in investments as well.
First of all, I'd like to thank you very much for being here. Thank you, Mauricio, Cesar. I'll try to focus a few moments here and try to analyze why people are so upset about the hedge funds from the transition in 2008, before 2008 and after 2008. And from my thinking, I understand that the problem that happened in 2008 was not a problem of the class of derivatives or hedge funds. I think that was much more a problem of the investors, of the high net worth individuals. I saw before 2008 a lot of people, a lot of clients came into my office and thinking about having a portfolio of, let's say, 80%, 90%, 70% of all their assets around the world invested in derivatives. It's not important how much do you trust or how much do you like hedge funds, but this high concentration is a problem. So I think that the beginning of the high net worth individual troubles with hedge funds are started with the asset allocation. I think that what happened was an abuse of the derivatives before 2008. I think that if you sit down with a client and you analyze a high net worth individual as an endowment or a pension fund or any a kind of institutional investor, we'll see that this individual has short-term needs, medium-term needs, and long-term needs. The money of a high net worth individual has a special purpose. It's something that will provide the benefits for the family and the money for their retirement. So a family, even without any debt, they have responsibilities. They have some special needs for the money. And if you treat the money of a high net worth individual or the money of any one of the professionals here, according to the techniques developed to manage portfolios, you'll see that if you have your short-term needs covered by short-term investments, your medium-term needs covered by the medium-term investment, and your long-term needs with the stocks, equities, and etc., then 2008 will never be a problem again for those kind of investors. So what I perceived that before 2008, people were much more invested than they like, what is reasonable to them to be invested. And after 2008, 2009, people in the opposite was less invested than it can be. So I think that my perception, my message here is tell to your clients, think about asset allocation. I think we do not have any problem with any of the three main categories of the investments: equities, derivatives, or fixed income. What we did have and what we will not should allow to have is concentration, is a mismatch between your assets and your liabilities. That's what I think. Thank you.
I don't know if it's any question that we could discuss or debate here by the audience.
Thank you for your thoughts, gentlemen. I was just wondering, the issue of asset allocation in Brazil, I fundamentally agree. That's the. Can you hear me?
It's very bad.
No.
Have to speak very close from the.
Okay. Is that better? This one? Okay. The issue of asset allocation to me is absolutely central, and I agree with that fundamentally. My question to you is, how common is that currently in your discussion with clients? Is this something that has to be explained from moment one, or are the clients beginning to understand that that's an important piece of the discussion? I.e., is it more common, or is it something still very new which has to be introduced and discussed?
I don't know if I would like you to precise a little bit more the question.
I'll rephrase.
Just to have the better answer.
I'm wondering how new do you think that the discussion around asset allocation, in-depth asset allocation, is to the current process of managing high net worth portfolios? Is this something very common, or is it something which is still being introduced and being discussed?
I mean, I can speak I can try to answer this question that for the high net worth individual, this asset class is not something that is being introducing right now, so it's something that it's familiar in my point of view. The fact is probably, it's not new, but probably there was some overinvestment in this area until 2008, and the fact that was, so people on this high net worth individual was investing more into 2008 without probably being so exigent on the information and also about what he was doing. But he still was doing that. It's not new for the high net worth, in my point of view. That's my personal impact. But I think for now on, people will ask for different things. So it's a different question coming on. But they are familiar with that, and probably other problems will come. It would not be the same that 2008. The fact is that probably it will take time probably to also to be a percentage of the investment on the asset allocation. I think people will take more time to get back on that. I don't know if my colleagues want to.
Well, I have a phrase I say always, that investors sometimes are as educated as the portfolio, as the advisor is. So sometimes, you know, I think that in general, I don't mean about maybe a family office which has more time to devote to a client, but in general, the clients that are serviced by bankers in general, they are not given much time, and they don't. So in that sense, you might see that, in my opinion, there is a big mismatch between the education the client has and and the banker, or even the family office. So that's a problem at the end of the day, because all of this that we are talking is possible if we were talking to someone that has kind of a reasonable level of education, financial education, so that we can be speaking the same language. And this we all know is not true. So it's a lot of our work, and I think Ricardo will agree with that, is very much psychological. We try to understand not what he's saying, but the meaning beyond the words. So it's our responsibility to try to understand. That's why the importance of the communication with the family, to get to the level of information, to understand how he feels about, and try to convey that into a portfolio that, on our side, we feel is good, because it's not a question of saying, telling him that he is right about everything and then the portfolio is a disaster. So try to understand that and put it into a simple way also that he can feel comfortable with that portfolio.
Well, let me try to put in terms of some numbers. Most people that I've read have written that 80 to 90% of the performance of a portfolio is due to asset allocation. The 10 or 20% is manager selection and tactical allocation. This Swensen says, it's a lot of people saying all of the time, since 30 years ago, I heard that. But when you go to a client and ask how long it takes, how many hours he spends thinking about asset allocation with the managers, they say it's less than 10% of the time. So answering your question, it's absolutely ridiculous. People don't think in asset allocation. And the change of mind in the first guy who stepped on the door, knocks on the door and say, well, look at this fantastic investment. 20% return, 5-year average. And the guy changes all the asset allocation. So what we try to help people to understand is that asset allocation is important, is 80, 90% of the result, is the DNA of your portfolio. So think about it. And every single investment book you read, they talk about discipline. And what is discipline in terms of investments? Is to follow your asset allocation. And that's it. If you had 30 or 40% of your portfolio in stocks, 20% of your portfolio in derivatives, the rest of your portfolio distributed in some fixed income, and this is matched with your needs, with your expenditures, doesn't matter it's 2008 or 2009 or 2005. It really doesn't matter. You will not change your portfolio, your asset allocation because of the market performance. You can control market performance. You can have an idea about the future of the markets, but you can't control your portfolio. This is the only thing you can control. A couple of months ago, I was reading the newspaper De Valor, and they made an evaluation of the time spent with the private bankers and the investors. And they came up with a number, you like the statistics, that 2/3 of the time that a client spends with a private banker is spent discussing fixed income. And you know that the difference between a good and a reasonable manager of fixed income is less than 0.5% per year. So what you're doing nothing. We're selecting managers for fixed income and spending 2/3 of your time. And how much you spend for your asset allocation? That's it. I agree with you. In average, people, the high net worth individual do not pay the attention needed to asset allocation.
I don't know if there are any other questions on the, please.
This is Elizabeth from Vera. Talking about asset allocation, as international investors, we all know how, let's say, a moderate or an aggressive or a conservative portfolio looks like in terms of a global asset allocation. Now, could you share with us how a Brazilian portfolio, I mean, a portfolio invested in Brazilian securities, looks like in terms of asset allocation, let's say for a moderate risk portfolio?
I can tell by the clients I supervise, but in general terms, I have only impressions. I don't have data to share with you. In terms of the asset allocation of the clients that we supervise, I'll tell you that we tend to match the assets and the liabilities of the family of the most. So what we do is try to figure out how much of their life are tied to Brazil, how much of the life are tied to Europe or United States. So in a sense that we can start for a hedge position for the family and then make the tactical adjustments. But what I can tell is that the families that I have that used to spend 2 or 3 months in Europe, or 2 or 3 months in the United States, and 2 or 3 months in Brazil, these kind of people, we have a more balanced portfolio. But the kind of people that we work that has, let's say, 90% of his time spent here, the next generations live in Brazil, so they have a very little money offshore. Just to give you an idea, 70% of the money we managed are invested in Brazil.
So I think just to be complementary on what he says, and maybe talking for high net worth individual abroad, not here but abroad. So they are looking, they are started to. I remember the first Latin American hedge fund conference when it happened in 2005. That people was like Brazil was completely out of radar. So today, all the people heard about Brazil and want to. So when you have something to say to them, they will listen first, and secondly, some of them more probably aggressive want to come and ask about that. And probably people are looking still for the Brazilian hedge fund industry as more like directional hedge fund. So it's probably still growing this industry. And but they want to follow that. So in a way to follow, they need to be probably they want to be a small piece invest, but it's a very, very small piece today.
Sorry, I'm afraid I realized I wasn't clear enough with my question, so if I may rephrase it. I understand you manage private money, so you look at it from the client perspective and you adopt
I do not understand you well.
Sorry, I understand you manage private money,
Yeah.
family money, and as a consequence you adopt let's say, an asset allocation criteria that's more geared towards asset liability management, matching both sides of the equation. My question was less related to that perspective, but more related to a pure, let's say, asset management, not wealth management perspective, meaning what I want to say is like a balanced portfolio that you would build with global securities would normally today bear 15% allocation in alternatives, something around 40% in fixed income, 50% in equities, or something around that with some variation. Now, my question is, how would that thing look like for a pure Brazilian portfolio, for a moderate risk portfolio? Would the hedge funds be 10%, 30%? How does allocation among these three major asset classes looks like in a Brazilian, pure Brazilian invested portfolio? That was my question. Thank you.
Okay. Basically, no.
I think she still wants some answers. Does this answer your question? Not yet. Okay.
We can talk later.
Maybe there is some other question.
Thank you. Ileana Salas from Trafalgar. Following on this same theme, my question is, how has the allocation to alternative funds changed between '08 and 2010 in most of your portfolios, first? And second, has there been a shift from perhaps selecting blue chip funds or hedge funds to boutiques, or the other way around?
So the change comes basically that people are looking, so we're trying to be much more on more liquid assets, more transparent. So we're looking for, so if you take the difference between before 2008 and now, it will be basically looking for more liquid strategies or more liquid funds, because at the end of the day, until 2008, we might see some liquid strategy, but not liquid funds. So what that we're trying to match right now, that if you go to a liquid strategy, it should be a liquid fund. So that was a big change, I think, and we're still looking. So basically today, before 2008, we wasn't looking for niche for some niche. This I'm talking for myself, but for niche strategy or niche funds, and which today we will look at on better way.
And with regards to whether you're selecting a liquid strategy or a liquid fund, would you have chosen a blue chip fund or a boutique in 2008, or would you do that differently now? Because, of course, there's a flight to safety and we have a confidence crisis, right? So at the same time, we have seen very big blue chip names from Wall Street crumble. So where do you put your trust? In your due diligence in a boutique that is an independent house? Or do you favor, let's say, products offered by the large institutions, regardless of what's happened in the last 2 years?
So in my point of view, I think we will try to do a search on, I don't think that more large institutions give you, might give you some comfort on the size of the company, but not probably, we saw in the explanation also, so it might be less performance on that. And sometimes the low, let's say we've been seeing that the more small companies communicate better, try to communicate better. So put the client at a certain higher level. So I would say that both could be, but I will be more open for more not very big. The big name, it won't make a huge difference.
I agree with what you've just said. The first thing I'd like to say is this a thing about alpha and beta that I mentioned at the beginning. I think real alpha is difficult to find. I think that I would say that real alpha means talent, and talent, as everywhere, is scarce. So to find real good managers is not so easy. Basically, we've been very lucky that the government decided, instead of doing what Japan did, to put money into the markets. Otherwise, we would have seen that the markets wouldn't have jumped back, and many managers would have not jumped back. So they were wrong about, staying basically long during a long period of time. Thanks God, this did not happen, and we are seeing another story. Now, relating to the size, I agree. I think that too big is, we saw it before. In 2007, we saw it. We saw it. The big funds were correlating basically with the equity market, very much. And therefore, we saw this lots of funds which fall into trouble. We always liked kind of middle-sized managers at the end of the day, because there is a point in which, and this depends a lot, very much in the strategy. A macro manager can be bigger, we all know this, and other funds could be smaller, like a long short, like a Japanese fund is a different size than an American fund maybe. But as you happen to see when you're investing in equities and you see that you have sector rotation, I think you would also, as an asset manager, realize that you will have to realize, depending on the macro that is coming to you, you need to probably rotate also the strategies you are invested in. I think one of the problems in the past was that, and this is all over, not only in hedge funds, but everywhere, is basically, you know, everyone can recommend to buy something, and then they sit for, and they'll never come back to you and tell you when is it time to sell, no? And we realized, and I do remember many years ago when I was marketing a fund of funds many years ago, the question was, you know, how much they rotated their underlying managers, and if the number was kind of above 10%, that was bad. And today, I think the opposite. If they rotate their managers and they realize what's coming to us and they move quickly from one to the next, probably smarter than staying until, you know, in less profitable strategies and also more risky strategies. We're seeing a shift also in what risk is at the end of the day. Is the emerging markets more risky than the developed markets? I mean, we're going to see now in fixed income. I think it's coming to us. I think the appetite for hedge funds has diminished after the crisis of 2008, and I think it's about to pick up. Basically because money chases returns, and fixed income is going to have a problem coming soon to them. So if that happens, money will have to go and look for something else, and suddenly, you know, pop, hedge funds are good again to put money to work into. And that's how you realize I'm investing into hedge funds, and I'm finding out that in the next 2 months, some of my best ideas are closing. So I'm realizing that, you know, money is coming. Smart people are putting more money to work, maybe faster than other people. But I think hedge funds are going to start having more appetite, and suddenly there'll be, you know, people, you know, the bankers will be recommending hedge funds that they were saying, you know, having 10%, and now they are going to start saying, you know, 20 sounds reasonable, and then they're going to say 30 sounds reasonable, and we know the story. But again, talent is what's more difficult to find. So I'm not sure that, you know, the thing is whether these managers, the family office, the advisor, is really understanding what he's doing, and he has a forthwith, you know, he looks at the future and realizes what the macro picture is, and also doesn't focus only in the US or only in Brazil or only, you know, but has an open mind to understand the world, what's the way it's moving. I think it's a challenging time, and you need smart people in your team, and then you need to talk to smart people also to get good ideas and know what's going on and move money around.
Well, if I remember, the first question was how the asset allocation have changed before 2008 and after 2008. I cannot lie because I have some managers that made money for our clients here in the audience. And they know that our strategy didn't change any from before 2008 to after 2008. Just for a simple issue, our strategy is not based on the market. Our strategy, our asset allocation is based on the life of the client and not on the market. So it should not any motivation to change because of the changes in the market. But some things change, not in terms of the essence, but in terms of the tactical movements. Before September 2008, if you had a portfolio of bonds in the US, AAA bonds would pay you, let's say, 0.2 or 0.3% plus treasuries. It means that every 5 years you earn 1%, or 500 years you can recover your capital. And I don't know much companies that survived for the last 500 years. So this is absolutely not paying the risk. But after 2008, or during 2009, we invest a lot in credit, because then those spreads go up to 300 basis points, 400 basis points, right? And now we have much more credit than we had in the past, because now it's paying for it. And before that, we preferred to have treasuries and bundes. Why not? But this is only tactical changes, not fundamental changes. The asset allocation remained the same, just like this.
Thank you.
I don't know if there is any other question in the room. So if it's not the case, so thank you very much, Mauri. Thank you for everything, and have a good continuation.